Hi, Michael Pena. I'm here with Alessandro and Manny, Lo que callamos los loan officers, provided with USA Loans. And let's get to it.
Awesome, man. Michael, thank you so much, man.
Yeah, absolutely. Thanks for being here. So, Alessandro, a lot of clients are out there, right? And they have money, let's just say, under the mattress.
All right.
And they deposit a large amount of money into the bank. The lender is asking for that documentation.
Right. So it's kind of interesting because we do have money. Right? A lot of people have money. It's just that some of us would prefer to have under the mattress cash, or we have it in other people's accounts, So when you're doing a transaction, you have to realize that the money has to be in your account, right? And the problem is that when we are putting a contract, the realtor goes and says, I need an extra money deposit. I need a check. So we go and run to the bank and deposit $5,000 cash, right? And that's what we do. So that's a problem. We cannot do that. You have to source where the money is coming from. And for that reason, I personally recommend for realtors, first is ask the borrowers, do you have the money in your account for at least 30 days? And I know it's probably a long question, but it will save you time. We have a lot of customers that, for example, they show, just to bring an idea, child support payments on their bank statement, or they show car payments on their bank statement. And to us, of course, we're counting that against the customer. That's perfect. But if for some reason that should not be there, because it happens, sometimes another person is paying for the child support for another person, just as a favor. I've seen it. So then now we have to count that child support against you when it's not even yours. So for that reason, your bank statement has to somehow be clean so that you can actually provide that deposit, because we're going to ask for that bank statement. And the bank statement shows large deposits or payments to auto payments, and it's not on your credit report. Then of course we're going to have to count that against you. So keep that account clean if possible. And we do have a series of what a bank statement should look like in terms of what we call it a clean bank statement, like no large deposit, no cash deposit, something like that. So that's what I would recommend, is having a good account for at least 30 days, because we're going to ask for everything inside that bank statement, like large deposits and payments that are made, to other people.
Absolutely.
Yeah, I've definitely had customers that have deposited before the EMD goes out, and it's really, when it comes to conditional time, it's always like, where's this money coming from, right?
Right.
And sometimes there's sourcing, sometimes there's not. When there's not, we have to find other solutions. When there is sourcing, it can be a variety of things. It can be they sold a car. It can be they got money from their mom, and that can be sourcing gift documentation and all that. So all that comes down to looking at, exactly like Alessandro said, looking at the bank statement prior to the EMD going out, or just having an idea that they have the money verbally. And all that really helps to avoid asking, where's this coming from?
And people get aggravated sometimes because, it's a lot of questions. And I've seen that probably 60 or 70% of the transactions will have an issue about a bank statement simply because it's not a clean bank statement. And I'm not saying we don't have clean bank statements, but it's just we don't think about what underwriters are going to be looking at in the bank statement. So that's why I highly recommend reviewing the bank statement. That should be the first item in your list of realtors, customers, loan officers. Look at the bank statement, because that's where the money goes. That's where the deposit for the payroll goes. That's where the money for down payment is going to come. Everything is going to be in that bank statement. So I highly recommend reviewing them. Now, is there a solution, of course, for this large deposit? Of course there is. There is always, there's always a solution.
Yeah.
Gifts, right? That's one of the best solutions to clean up a mess in a bank statement, for example,
So for the realtors to be very proactive is asking that question ahead of time.
Yes.
During the buyer consultation, for example, is asking where the funds coming from to be prepared.
Yeah, and I've seen it so many times where realtors don't want to ask because they don't want to they want to intrude, and I get it, right? Yeah. But I also seen realtors that do that, and they actually have a higher success ratio in terms of closing, because it's not that they want to get involved in the person's finances, but they just want to make sure that the loan closes and they're prepared for that. I had a transaction recently where we're doing a profit and loss transaction, and the realtor says, "Hey Ale, I just gave you this customer, But I want to tell you already up front, this guy has $300,000 deposit in the last 2 months, and we cannot source it. Like, how do you know? It's because we just did a flip and we had the money. So I was like, maybe you can source that, right? He said, no, we cannot source it. So he already knew what, we were coming into. And there is nothing wrong with realtors getting involved in the finances, because I feel that we had a higher success ratio, because had that not happened, let's say the customer had gone to another bank and do a profit and loss program, we would have asked for the bank statement. And guess what? We will have seen those deposits in there. And then we're already 2 weeks ahead, right? And we didn't see that. So it's always good to ask the questions. I highly recommend that.
Yeah. I think it's paramount to ask those questions ahead of time, because you're avoiding those pitfalls, right? There's a lot to navigate in the contract and in an offer that you submit, and you want to know all the information ahead of time. So for realtors out there, you have to be proactive in obtaining that information early on, pass it over to you guys to do the financial aspect of it, and get to closing smooth.
Yeah, for sure.
So I think it's so important. So, recently we've had government shuffling around a lot of jobs, right? I think we're seeing that a lot recently in the DMV market. How are you handling clients that obtain a new job during the loan process, which can potentially affect the process?
It's a great question.
Yeah.
The first thing when someone tells us, I'm getting a new job and we're already pre-approved or in underwriting or a week from closing. The first thing we ask is, are you making more or the same at least? Because if you're making less, we're in a problem. We have a problem. So, that's the first thing that I ask my clients. And if they're making more or the same, great. Give me the offer letter. Give me the first pay stub if you're going to get it before closing. But I do definitely always ask my clients that question, because it can make major issues if they're making less. And even if they're making less and they still qualify, the underwriter may still question it. I've seen it.
Wow.
I've had a client that actually, 3 days before closing, he actually got a new job.
Wow.
And, he was going to have his job the day of closing, and the day after he was going to be on a new job. We had to disclose it, obviously.
Right.
And so we showed them the offer letter, and we're like, hey, he's going to work this new job. He's making $10K more. They had to go back to underwriting. They had to reapprove the file, update the log, update everything to make sure that it's good to go and send the package out again. Luckily, we still closed on time, but it can cause some hiccups in the loan process for sure. But
and also, we had situations where, for example, the person, it's not the fact that you change industry, but you change the way that you're getting paid. So a lot of that happens. You could be making more money, right? But then you're going from salary to a commission base.
Wow.
That's a big problem, because the guidelines state that you have to have at least 1 year of receiving commission. The same thing for overtime, the same thing for bonus. So when you have those changes, it messes up the file. So, do I recommend it? No. It doesn't happen. It happens all the time, but just keep that in mind, that if you change something like a job, then you have to also think as, am I changing the type of payment, how I'm getting paid from salary to an overtime, salary to a commission, or salary to a tip income. You have to have the history of that, because that's called variable income, and variable income has to be average. So that's why 1 year at least at that type of position, it will be recommended. Now, in another scenario where the person already has changed jobs, right? It has been working for 6 months as commission income and was previously a salary. You can always go back to salary. You can talk to your boss and say, hey, this is not working for me. Maybe can you put me back to salary? And that could also work out. That's a solution for you guys. If you're already commissioned, it's not working out because you don't have the time that you need in order to use that income, then go back to salary and that will solve it. Another idea, for example, will be switching industries. We go back to those scenarios where you have self-employees and then now you are W-2. That's good. Self-employed to W-2, that's perfect. By going from what is it? W-2 to self-employed, that is a problem. That is a problem. So because again, self-employment is an average income, and if you don't have the 2 years, then that's a problem, right? So we have different situations like that, and it messes it up
for sure. For sure.
So, you have clients that may have a high salary that we just talked about, a lot of money under the mattress. They deposit it. Everything is good. It's clean. But their debt to income ratio is too high. what can they do to overcome that?
Right. So the first things, pay off debt. In my opinion, that's the easiest way. We have situations where they have auto loans. We have, in a lot of situations where you have auto loans and those are not even yours. Yeah. you see 3 car payments on the credit report and that's not mine. Wow. That's my parents, that's my brother. So keep that in mind that increases your DTI, your debt to income ratio, which decreases the amount that you can qualify for. So for that reason, how can you fix that? Is removing those car payments from your credit. Can that happen? Of course. You can either go to the dealer and trade in the cars and that somebody else gets the new debt, or refinance the car into somebody else's name. I know there's a lot of banks that would say, no, that's not possible. Yes, it is possible. We've done it many times. We obviously need time to make that happen. Sometimes we have customers that are like, I put a contract, now let's refinance that car. I'm like, oh my God, we are under pressure now because we have to refinance the car first and then re-score the credit and then we can start submitting the file. So I would recommend get prepared. If you already know that you have to pay off those cars or remove it from your credit, you have to go to those banks first. And it would probably take 2 weeks to 2 weeks and a half to make that happen. But it is possible to do that. And if you need, help with that, please call us at 1-800-485-0102, 1-800-485-0102, and we can give you some ideas about that. Another way that we can reduce the DTI is increasing the income. We have situations where customers actually say, hey, boss, I need a raise. And that can actually solve the problem, right? And that will usually solve the problem. Most of the time I had situations where that was happening. During the process, the lady was actually going through an adjustment on her salary. She was negotiating. We didn't know that. And we were having issues with the income. And we were like, I don't know what's going to happen because she suddenly had a change in her DTI, in her debt. So we were talking to her and like, we're having issues with your debt. You recently got this new debt and we cannot qualify you anymore. And then she's like, oh, wait, but I'm working on a raise right now. That's perfect. That will solve it. And she got us a new letter she was negotiating her new salary and it worked out perfectly. So that's another solution for the income.
On that piece, Alessandro, I have a question. What amount would you like to see? What amount have you seen that helps with that DTI? Is it like a 5,000, 10,000?
Yeah, so a year, right? We're talking about 5,000 to 10,000 increase a year. That helps a lot, actually. We have situations where even 6,000, can help. I would say that would be one idea to increase the income. If it is 5,000 to 10,000, that's perfect. That's a lot, actually. That actually helps a lot. Another option, and you can maybe, confirm this because I've seen that when going conventional to FHA, for example, allows to have that flexibility, right? Because you have changing the loan type would allow you to get more depth.
Wow.
And we had situations with your customers as well that, did that recently, right? So they went from conventional to FHA. But what would you say is the reason?
The overall DTI ceiling is higher in FHA, so you could have more debt, right? You can have more debt, and it allows you to qualify, extend your qualification a little more. One of the things that a lot of my clients did this year, though, to avoid DTI issues, is actually adding a cosigner. That was a big thing that this year I've seen probably 40-50% of my clients had a cosigner. Wow. And you can blame it on the rates because they've been, being higher and they need help qualifying. But it is something that's very common now. Get your aunt, uncle, brother, sister, mom, whomever who needs to be on the loan with you just to qualify. So adding a cosigner can always bring your DTI down. Just keep in mind, though, if you add a cosigner, it includes their whole entire debt as well from the cosigner. It's not just their income. It's their credit, debt, history. We look at everything like they're the borrower, the main borrower, right? And then the second thing I would say is buying points. A lot of people in this current rate market, maybe not, but in the past, that's how I would get, 2, 3, 4, 5% down on DTI.
Yeah.
Exactly. Just buying points, using seller credit to buy points or vice versa, whatever it needs to be done.
That reminds me, actually buying down points is better than putting more down payment. Mm-hmm. I was looking at that the other day with a customer. She was like, can you show me the difference as to should I put more money down or should I buy down the points? And buying down the points had a better effect on the DTI than putting more down payment. So that actually made more sense. And then the question is, up to how many points can I buy, right? Because there is a maximum. There is a 3% rule that is in place where all the costs go in there. I would say I try not to buy more than 2 points, because that's, in my opinion, that's really going to be the maximum for a file. It changes depending on the file, but that helps a lot, buying down points, reducing the rate. Another idea here is insurance. Sometimes we have homeowners insurance. We go with a bundle, right? With our we have our insurance. We pick the homeowners insurance with that company, but it turns out sometimes it's higher than the other quotes that we are helping the customer get, because we have a lot of companies that we work with, and they provide us quotes, and they give us like $700,000 less, and it's a no-brainer. So sometimes it's better to have that insurance, because it will lower your DTI, and it will allow you to actually qualify. So that's another idea.
That's a good option.
Right. Yeah.
I wanted to follow up on what you just said, Manny, with the co-signers. Like, what are some things that the clients should be looking for or expect when they're doing a co-signing for the loan?
Good question. So if they have a co-signer or co-borrower in the mortgage, they're financially responsible for the mortgage debt just as much as the primary borrower. And when I have people that are qualifying together and co-sign with a co-signer, they always say, hey, make me first. I want to be first. It's mine. And it's like, just so you know, it makes no difference. You still owe this money to the bank. So and then make them second, because, I want to have more rights. No, you don't have more rights. You have equal rights. So, the bank's going to go after both of you. And going back to the topic of what's needed, it's the full application, full qualification, the same thing we do for the first borrower. Co-signers need to qualify with documents the same way as the first one. There's no difference. The only difference that I can mention on that topic is if you have a non-occupant co-borrower, non-occupant co-signer, that's when things get a little different, because we still look at their full qualification, their income, their debts, their credit, everything. But we have to hit the DTI with that client's or the co-signer's mortgage payment or their rental payment.
Oh, wow.
So it's adding more debt to it. Right. But if there's enough income, hey,
But that's why it's better that if they move in together, these two people, then that's actually easier, because they will have less debt. Yeah. But if they don't move in together, then that's a problem. Now we have to add the rental, like he said, and that's the biggest issue that we find there. Another thing I wanted to add there is the fact that a lot of these customers, the consigners, they said, I just want to be there for a year. Mm-hmm. And of course, we cannot confirm that they will only be there for a year, because what it means that in a year, that main borrower now has to make enough what this person was bringing to be able to qualify in a year. Mm-hmm. And so we gotta be realistic. Is that going to happen, my friend?
Right.
Is that going to happen? Are you going to be making the money for the both of you in a year? If not, then be realistic. When can I remove this person? That will give you a solution. Potentially, we cannot remove that person. But if you, borrower one, have been paying for that mortgage for 12 months, and you can provide a proof that you alone are paying for those 12 payments, now this person does not have to count the mortgage against them. Now he can buy another house. Borrower number two can buy their own house after 1 year, showing I don't pay for that mortgage because borrower one pays for it, and I can go and buy my own property. That's a solution there. And a lot of people are scared that, I won't be able to buy. Yes, you will be able to buy, but you just have to wait until you have the 12-month payment, proof of payment that the other person is making.
It just goes back to educating the clients, right? I mean, I don't think a lot of people know of that solution. So, to be able to do that, I think it's amazing.
Yes.
To do that. So,
but that's why we need the information. The people are not educating, the consumers. So this is the time that we have, to do that.
So with that, let's end this here, guys. Thanks for providing those solutions for our clients. My name is Michael Pena, and we'll see you next time.
All right. See you guys.
Thank you.
Bye.